going to talk a little bit about how markets work. So, right, the main topic is what happens when you hit the buy button. We're going to try to give you a little bit of a, I guess, behind the scenes look into how trading and how trades actually are executed in today's modern markets. And I thought maybe a good place to start, Eric, just to get things going, is maybe you could explain to us what a broker dealer is and what types of services they provide for their customers.
Yeah, so when we were talking about this and planning for today, we talked a lot about all the different kinds of securities and things out there. And there's so many different markets out there: equity markets, futures markets, treasury markets, corporate debt markets, options markets. But I think we're going to try to focus mostly on the equity markets. And broker dealers are how orders get executed in the marketplace today. So no equity order in the United States is executed except through a broker dealer. So they are registered with FINRA, which is a self-regulatory organization that registers all broker dealers. And their job really is to take a customer's order. They act on behalf of the customer as an agent in the marketplace, generally, and then go and try to deliver what is called best execution on behalf of that customer. So if a customer ABC wants to buy Apple, and they submit their order to their broker dealer, whether it's electronically or calling a broker on the phone, and that broker then is responsible for executing the order with the restrictions that the client may have already put on the order. So, you know, a limit order or some other kind of restriction. And then the client executes that order into the marketplace, trying to deliver the very best price at that moment in time. And I think that's an important factor in this, is at that moment in time to deliver the best price for the client under the current circumstances. So every order in the United States goes through some process through a broker dealer before it actually gets executed.
So when you take a look inside a broker dealer, how does a broker dealer actually make money? Like, what are the sources of revenues that a broker dealer has available to it?
Yeah, so there are several sources of where broker dealers make money. The ones that we are most commonly familiar with are broker dealers make money by charging a commission to their clients on the execution. But that's a model that has broken away and broken down over the last couple of years, and particularly in the last years with, you know, what we would call free executions, and I'll put that in quotes for a minute. Other ways broker dealers make money on a customer order are several. One is if you maintain balances at a broker dealer, broker dealers make money on the balances that are actually being held by the broker dealer on your behalf. So they may pay you an interest rate on them, but they're earning more interest than they're paying you. So they're making an interest rate spread on that. They may make a margin loan to you, and they make money on that margin. They collect payment for order flow, oftentimes, particularly for retail orders. So what payment for order flow is really is retail order flow, or what we would call uninformed order flow in the business, meaning nobody's an insider, nobody has real detailed information about what's going on with the stock, is very valuable for market makers. And market makers will pay a fee, typically a per share charge, a per share fee, back to a broker dealer in order to get that order delivered to them as a market maker first. So broker dealers make money on payment for order flow. They also make money on what we call short sale rebate. So for many of us in the business, we understand short selling, but short selling is selling a stock that you don't own because you believe the stock price is going down. The securities rules in the United States say, well, in order for you to sell a stock short, you have to know where it is, and you have to borrow it from the person who owns the share of stock already. And so when you borrow that, there is a fee that goes back to the person you borrowed it from, typically the broker dealer, which is called a short sale rebate. And generally that's a variable price depending on how difficult to borrow or how illiquid the underlying security is. So those are many different ways that broker dealers make money on order flow and on your orders as they come into the marketplace. The value of some of those alternatives that I just mentioned, short sale rebate, balances, margin loans, payment for order flow, have been lucrative enough that many brokers are now offering free executions in the marketplace and no longer charging commissions in the traditional model.
It's been a really interesting transition, or sort of, the way it was paved, I guess, by Robinhood, but it didn't take long for most of the other
everybody else to get on board.
Retail. Yeah, it's amazing how quickly that model collapsed. So let's start to now to think about. So now I'm an investor. I have a trade. I want to buy, let's say, 100 shares of Tesla, and I approach let's say I have an account at a place like Schwab, right? So I open I log on. I tell Schwab I would like to place an order. I have a number of different options that I have to pick. So maybe before we can maybe circle back to talk about how you should be placing an order and whether it should be a limit order or a market order. But let's say that I place that. What happens? What's the first thing that happens once I tell Schwab I'd like to buy some Tesla?
Yep. So there are two types of, well, there are many types of orders that you can place as a client of Schwab or any other broker dealer for that matter. But I will call them a difference between a market order and a priced order. And those are probably the most interesting initial distinctions. A market order means essentially if I want to buy Tesla, I'm willing to buy it at whatever price the broker dealer can get it for me at the moment I submit my order. So I'm not putting any restrictions on that order at all. I just want to own Tesla. So when I hit the buy button, the broker dealer then looks into the marketplace using all of the market data sources that are out there and determines what is the national best bid and offer that is currently resident out there. We call it an NBBO, National Best Bid and Offer. And the order typically has to be executed within that NBBO in the marketplace. So they're looking on where they can execute that order. And here's where it gets really complicated. There are 15 exchanges out there in the world today that represent only about 45 to 50% of the actual daily volume that takes place in securities market during the day. The remainder of that volume takes place off exchange, typically in dark pools, but also with market makers and other liquidity providers in the marketplace. And as a retail order, your order is highly unlikely to ever touch an exchange. So many of us know Tesla's listed on NASDAQ. If I submit my buy order to buy Tesla through Schwab, particularly a market order, the odds are probably less than 1% that order is going to get executed on NASDAQ. In fact, your order is probably going to be routed to a market maker or a dark pool, which will execute your order at or within the NBBO. But what's particularly interesting about it is retail orders in particular are usually getting a better price than the national best bid and offer. So they're getting what we would call price improvement because the value of that order flow, again, because it's directionless, it's informationless, allows market makers to make a better spread inside the national best bid and offer for retail order flow. So that order is likely to be routed to a market maker relationship of the broker dealer, a dark pool affiliated with the broker dealer, or in some cases, their own proprietary market making desk, depending on who you're executing through.
And those internal desks are called internalizers?
They're called internalizers.
And so basically the way an internalizer works is that if other investors have placed limit orders and they're sitting on the books of that broker dealer, when a sort of informationless order comes in, that they will try to match that against the outstanding orders. And if they can achieve that, then that's a valuable trade for the broker dealer,
Yep.
because they clean the entire bid-ask spread, right?
That's right. And so when they build a big enough book of limit orders and market orders, again using Tesla as an example, on their internalizing book, they essentially have created, if you will, inside their own firm, a mini exchange where orders are interacting. Customers are interacting with other customer orders, with the internalizer providing capital where necessary to bridge those trades when they have to.
Great. Now you mentioned dark pools, and dark pools are also sometimes referred to as alternative trading systems. From the perspective of an investor, should you care whether your order makes it to an organized exchange or whether it gets executed in a dark pool?
It's a great topic, and one that we could probably spend a way longer amount of time on. First of all, I think the name dark pools is the worst name that could have ever been created for a market functionality, because there's ramifications to that people are suspicious of them. But generally, trades that take place in dark pools or off exchange, particularly for retail order flow, are generally getting better executions than they would if they were going to an exchange. They're generally getting price improvement. They're generally trading between the bid offer spread. And even when they're not, the friction costs for trading away from an exchange are generally much lower than they are when you do trade on an exchange. And when I say friction costs, that means, how do you pay for access? How do you pay for market data? All of the other things that are expenses for executing a trade are lower when you're executing off exchange. And so generally, I think if you shouldn't care at all where your order gets executed. If I were a retail investor and I noticed that lots of my trades are getting executed on exchanges, I might start asking questions the other way about why my order is ending up on an exchange. And am I being disenfranchised in some way by having my order not treated at an internalizer or a dark pool?
No, that's a great point. So suppose that I was interested in starting a firm that competed with Robinhood, right? And I was going to build my company up. Would I be willing to route my orders to regular exchanges?
I would say no. I would say the only way my business model could work, and it would benefit my clients, would be to develop relationship with dark pools and or internalizers or market makers who are willing to execute orders on my behalf or for my clients.
And then I would be receiving compensation for directing my order flow to you. You talked about payment for order flow.
Yep.
What types of how do I protect my investors, or how do I protect my business model? I'm sure that there are different rates that are paid across the different dark pools.
Yep.
How do I choose which one? Do I just go to the one that pays me the most, or do I look for the ones that give my clients the best execution quality?
Yeah. So the rules for routing and execution are that compensation that you receive should have no impact on where you route your orders. What the key and the SEC and FINRA in particular are pretty vigorous around this, measuring best execution results. It should be, where am I getting the best execution for my clients? And typically they're looking at, how often do my clients receive price improvement? How often do they get an execution outside the NBBO, which actually is quite rare in today's markets. And those are really the metrics that you use to determine where my order flow should go to.
And thanks, Eric. I think that makes a lot of sense. And so from an investor's perspective, once I place my trade, there's a lot that's taking place sort of underneath the hood, right, that I never see. What would be, I guess, you talked about execution quality and price improvement. When I am directing, and so you mentioned what there were 15 exchanges, 16
Yep.
exchanges. There
And
are
more coming.
more coming. Yeah, some people think as many as 20 some, in the next year, not new incrementally 20, but up to 20.
Yeah.
Right there are 56 as of October this year. There are 56 dark pools, call them alternative trading systems that exist. How does a company select the place to put the order? What is it that outside of payment for order flow maybe, and do you build up a reputation or sort of a relationship with a trading venue, or do you just search for the best possible?
Yeah, so there's a couple ways that people do that. One is that almost every firm has what's called a smart order router built into their back office system. And the smart order router is looking at all of the venues. And there is an obligation on the part of a broker dealer to make sure that they are examining different alternatives and different places they can go for execution. So almost every firm has a version of a smart order router built into it, which is evaluating all the current best bids and offers across all of the different venues, including dark pools and where things can be executed. And so it becomes very challenging for a broker dealer to route an order to somebody that is not either guaranteeing or willing to be on the national best bid and offer. So if somebody is away from the market, as we say, that's a venue that comes out of the routing table. I can't go there because they're not where they're supposed to be. But you're looking for liquidity. So I might be the best bid and offer in the national market system, but if I'm only 100 shares up and I have no liquidity behind that, and I have an order for 10,000 shares to be executed, the odds are pretty high that I probably shouldn't go to that venue, though I may want to take that 100 out on my way to somewhere else to get that filled. But so we're looking at liquidity, we're looking at national bid and offer, but a lot of times it's relationships and it's understanding with venues. Particularly on the retail side, there are lots of discussions of I will route you 20%, 30%, 50% of my retail order flow if you are going to give me price improvement with these kind of metrics. So I want 20% of all my orders to be price improved at least a penny, or at least 5%. And firms are willing to negotiate around that and say, yes, for your order flow, I'm willing to treat it this way. And it's a competitive matrix for internalizers and dark pools, and even exchanges to a certain extent in the marketplace, which is, I want your flow. Here's what I'm going to do for you to get your flow, which generally benefits the client, which is how is the order getting better?
So you mentioned something kind of interesting, I think, and that is you might take out 100 shares along the way to getting your 10,000 share order executed. One of the things that we talk about when we speak about equity markets in the classroom setting is adverse selection, and the idea that somebody who wants to sell 10,000 shares of stock knows a lot more about what's happening to that particular company than the market maker does. And
Yes.
So if you were to come in with 10,000 shares and try to sell them as a big block and say, here's the 10,000 I'm trying to sell, people are probably going to start lowering the price, right?
Yeah.
Because they figure something's going on. How do you protect yourself? Do these smart order routers understand that adverse selection component? And if they do, how do they achieve that? Or how do they sort of implement that?
So smart order routers are, and again, I want to be really clear, make a distinction here between what I'll call institutional flow and retail flow. So retail flow is generally more insensitive to, that adverse selection effect. And it's very difficult, other than a limit order, to protect yourself against that sort of adverse selection effect in the marketplace as a retail order. Generally they're of a size where they're not moving the market. They're not signaling to a market maker that something is going on in this stock that's going to work against me. Smart order routers and algorithms and algorithmic execution are primarily an institutional tool. And they are, quite frankly, designed to hide their intention from the marketplace. They are designed in a way to not signal to markets that we are moving a big block of stock through here, and you as a market maker, we want you to get, we're letting you know that because they want to get the best execution they can on behalf of their client with their order. So almost every algorithm or smart order router that's working out there is designed, if you will, to hide the intention of the execution from the rest of the market, so that they are taking advantage, if you will, of that adverse selection and trying to get as much liquidity as they can before market makers recognize that something's happening in a stock and prices should move.
So let's pivot briefly to institutional trading a little bit. And should people who are retail investors be worried about high frequency traders?
It's a great question. And again, high frequency trading, like dark pools, has gotten to a large extent a bad rap in the marketplace, particularly for retail investors. I can understand some of the sensitivities around institutions and their concerns around high frequency trading, but for retail investors, it's hard to see the negative impact on a retail order with high frequency trading. Maybe it would help to just talk about what high frequency trading is for a minute, just so people can understand that. Most exchanges and most markets work on something called a maker-taker principle. And there are variations on that maker-taker principle. One of the reasons why there are so many exchanges out there is that within an exchange, there are different pricing models around maker-taker, or an inverted taker-maker model. And don't want to get too complicated with all the details around that. But in order to present us a new way to price way orders get executed, you typically need another exchange to be able to execute that new pricing modality. But in its most basic form, a maker-taker exchange is one where a liquidity provider, or you could call them a high frequency trader in this case, is paid a rebate by the venue, whether it's a dark pool or an exchange, is paying a rebate to the provider of liquidity in the marketplace. So a market maker or a limit order that's on the books. And when you take liquidity, in other words, you're hitting that bid or offer in the marketplace, you're paying a fee. And the way an exchange or a venue makes money is they charge you slightly more than they're paying out in a rebate. So they're making the spread between the maker-taker rebate. So what a high-frequency trader or an electronic market maker in the marketplace is doing today is constantly updating their bids and offers using computers to keep that national best bid and offer. And they are also time priority driven. So in other words, it's the best price gets the next trade, but it's the best price that's there the soonest. So there's a constant recalibration being done electronically by high frequency traders to be at the best price and being first at the best price. So as prices move around, they're constantly refreshing their the national best bid and offer, or their best bid and offer. And because those price changes occur multiple times in a second, they're considered to be high frequency traders, because that's the nature of what they're trying to do, is trying to always be at the top of the book all the time. The benefits of that, though, is that has really tightened spreads. So if you look historically back in time from when we moved to this electronic market maker system, spreads have compressed dramatically. Because of that competition among market makers have really compressed spreads, and that's made it much less expensive for retail orders to be executed in the marketplace. One of the differences, and not to belabor the point, is if I want to get a lot of size done, on the other hand, that is more complicated for an institution now, because the bid offer spreads are what we would call thin in terms of liquidity. Again, market makers avoiding adverse selection. And so if I have to move a lot of stock, I have to manage that very carefully in the marketplace to keep the price from moving fast away from me.
Right. So, and that's what I'd like to do maybe is sort of probe a little bit more around high frequency trading, right? And so, from my perspective, when you actually look at the what a high frequency trader brings to the market, they function much like a regular market maker who would register at an exchange as a market maker, right? They're liquidity providers, right?
Yes.
And their profit motive is trying to understand where the order flow is going so that they can, as you described, jump ahead of that and try to extract some rents on the way up or the way down by being the first in.
Yes.
And that used to be a very lucrative business. I don't think it's quite as profitable today as it once was.
Not as much as it was.
And so, but there's a tension, right, that exists between somebody who's registered as a market maker on the Nasdaq, for example, and a high frequency trader, because the registered market maker has an obligation to provide continuous quotes or to maintain continuous quotes and be ready to stand in and buy and sell at whatever prices they're posting. Whereas HFT can leave the market whenever they want. And I'm going to bring back probably my all-time favorite quote from my days at the SEC that was offered up by yours truly. And you indicated that as you were at the Nasdaq at the time, but you said that the Nasdaq, its market makers feel like they're standing at the end of an exhaust pipe from a car, and whenever the things bad happen, the HFTs disappear, and our market makers are sitting there sucking the fumes.
That's right. That's right. And that's one of the more interesting challenges is how the market's evolved and it has created that thing. So many of us remember in the old days when New York had specialists and NASDAQ had registered market makers who had obligations. And to a certain extent, exchanges still maintain vestiges of that model. Though the New York specialist system is now gone, but there are market makers that have obligations, if you will, to make a two-sided market. And and this is something I learned from you and something I learned from Hans Stoll in classes, is that when I'm a market maker and I'm putting a bid or offer out there, I'm writing an option to the rest of the marketplace. So I'm giving something away when I do that. And how I get rewarded for that is typically I'm able to capture the bid offer spread, or I have a time and place advantage in the marketplace in return for giving that option away to the marketplace. And as the markets have evolved in this new paradigm, the person who is obligated to be on the bid offer spread some percentage of the time, 100% of the time, whatever the percentage is giving away more than they're getting rewarded. And so when I made that quote to you, and I think we were talking about the flash crash, actually.
We were, yeah.
At the time. What ends up happening is if I'm a market maker who has an economic, or if I'm an HFT who has an economic incentive to be in the marketplace, I'm going to be inside or competing with people who have obligations, and that's good for me. But when there is a market event, a volatility event, some other thing that happens in the marketplace that causes a dislocation in the marketplace, I am no longer obligated to catch a falling knife. And so I turn my machine off or I step away from the marketplace. On the other hand, though, a market maker who's registered on an exchange and has an affirmative obligation still has to stand there. And they are required at that point to make a market at the time that no one wants to make a market. And so one of the other effects, I think, of the market as it's evolved over time is there are fewer and fewer market makers. And it's one of the reasons why spreads on exchanges tend to be wider than executions received by retail holders, is because people on exchanges have obligations, and those people who have obligations are being what we would call pennied in the marketplace by high frequency traders who are trading in between them because they don't have obligations. And that's a longer term liquidity issue that we have to, that the markets have yet to really fix in any real way.
Thanks, Eric. I think we're getting close to the end of our sort of allocated time, so then we can turn it open to questions. But let me just close with one last question for you, maybe a little more practical advice.
Sure.
If you're a retail investor and you're looking to trade, do you have any, how would you, are there any ideas you would have for what's the best way to place an order, right? Knowing that this huge set of plumbing exists sort of underneath the surface, what would you do if you wanted to, say, buy or sell stock? Is there any advice?
Yeah, so the only advice I would give is that modern securities markets, particularly equity markets, are dominated by professionals who have great data sources, great algorithms, great tools for executing their orders and essentially putting their vision of where they want to invest their money into the marketplace. So I would start out by saying that unless you are willing to put the time in and have real insight into where you are with a particular security, that to try to compete with people that they do this for a living is probably not a particularly lucrative exercise for you. So trying to be a great day trader, trying to beat the market, I think is very difficult. On the other hand, if you are a long-term investor in equities, there are ways that you could present your orders in the marketplace that get you relatively protected. One is that I think putting in a limit order is more helpful than a market order, particularly if you don't have time urgency for your execution. So if you need to execute something immediately, then a market order gets that done. If the other hand, you're very price sensitive about where you want to enter a trade, put a limit on it, because I think that's really important for you. I'm a skeptic of stop loss orders as a retail tool. And for those of you who may or may not know, a stop loss order is essentially when I have a limit order in the marketplace, I also put or I own a security, I may put a stop loss order underneath that says, if the market ever touches this price, sell. What experience of a lot of people with stop loss orders or even sliding stop orders is they get triggered just when they don't want to get it triggered. Because in many ways you are, again, just like a market maker, you're writing an option to the marketplace that exists out there, and you oftentimes will get selected negatively. If there's a brief flash crash in a stock, you could find yourself having sold stock at a price you don't want to sell it at, or losing shares that you think you want it to hold for the longer term. So I'm not a fan of stop loss orders, but I am a fan of putting priced orders into the marketplace, meaning using a limit order.
Yeah, I would concur. I think that's definitely, you should be using limit orders. If you don't use limit orders, that should be the way you trade.
Yeah.
All right. Thanks, Eric. All right, Eric Cahill.
Well,
turn it back over to you.
Thank you both for this time, and thank you both for sharing your wisdom. Some questions have come in here, and I kind of want to go through them in the order in which they've come in. So one of the questions, and to follow up really on what you were talking about on retail investing, there is a question regarding the impact of places like Schwab, Fidelity, and Robinhood offering zero commission trades. And are they doing a service for the market, or are they providing additional risk for a retail investor? And how would you assess that?
I don't know how Craig feels about it, but I'll start by saying that I think they are providing an additional service to the marketplace, because what they've done is they've democratized to a large extent the ability for smaller investors to participate more robustly in the marketplace. And it is probably less about the free commission, though that certainly helps. But one of the things that Robinhood and Schwab and all the others have innovated around is this ability to buy partial shares. So now in the marketplace, if you're on one of these platforms, you can actually, if you had $100 or $1,000, you could actually buy multiple shares of stock, or what I would say interests in multiple shares in stock. You don't actually own a full share, but you could go into Schwab and say, I want to buy these 10 stocks with my $1,000, and you would get partial shares in each of them, and you would get that exposure. So there's a great democratization that's going on with these kind of these new entries into the marketplace. Like everything else, though, there's a downside to it, which is because it's less expensive and your costs to trade are less visible to you, people tend to trade more often. And because they're trading more often, they often are making mistakes, or they're chasing a dream. And so they expose themselves to more risk than they may be comfortable with, or may not even be realizing that they're taking. It also, one of the phenomena we've seen is particularly millennials love story stocks in today's world. So one of the more interesting things that has happened is, particularly with some of the more vibrant platforms, it's a huge influx of millennial investing in, say, marijuana stocks. Everybody thinks marijuana is the new gold rush. I got to get long these securities. They buy a lot of shares in the stock. It's created a really interesting dynamic too, because hedge funds generally view marijuana stocks as expensive, with poor business models. And so they're borrowing the shares and selling them short, while the millennials are buying in more and more of them. So there's this really weird phenomena that's going on around those things. That's kind of been mitigated lately, but in the early days, that was a really interesting phenomena that we had noticed.
So I'll weigh in just briefly on sort of the no commit, the zero commission, sort of proposition. And I completely agree with Eric. It's opened up equity trading to a much broader group of individuals. And one of the great things about it really is, I think, the participation of millennials and bringing that generation into the markets and giving them an opportunity to invest and get interested in investing, and really thinking about how the savings function should be working for them as they get older. So to me, that's sort of a net benefit, societal benefit. I would also say that one of the great things about participating in equity markets is they are priced to earn a positive return over time. And if you think about the alternative ways they might be spending their money, which could be participating in fantasy football leagues or online gaming, this is certainly an investment that's expected to win for them, as opposed to one that's expected to lose for them over time. So think about what asset class you want to compare it against. But I will say that the number of people during the pandemic that have opened up accounts at like Robinhood is tens of thousands of people, right? I mean, it's really been a huge surge in interest in markets, and I think in the long run that has to be good for the economy.
Yeah, I mean, to your point, which is a great point actually, is if you want to think of it in terms of game theory or gaming theory or probability, where many people invest in sports books, FanDuel, the corner bookie, online gaming, the odds are stacked against you when you're in those venues, right? The probabilities are that you're going to lose as opposed to win. On the other hand, equity markets are, in fact, the probabilities are longer term appreciation over time, and so it is a net positive to have more people involved in that.
Yep.
Let's switch gears over to talking about machine trading a little bit. And the question comes in and says, do you see continued development of quantum computing, crypto assets, et cetera, as more of a threat, boom for proliferating markets?
On the crypto side, I've gone back and forth around crypto assets and crypto trading. I think one of the things I would say about the crypto space is it's here to stay. I think there are still some regulatory issues about what they are, how they work, who's going to regulate them, should they be regulated, in what way should they be regulated. But I do think that they are, I like to review, I know the Winklevoss twins in the crypto space, and they refer to crypto assets as digital gold. So if
It is.
which is essentially what it's become, which is it's a store of value that you're storing digitally. So I think, is the day ever going to come when we're going to use Bitcoin to pay for our gasoline? Maybe, but it's not going to be tomorrow. But as a store of value, it certainly can be a store of value, and we've seen that. In terms of machine learning, though, and machine executions, that's here to stay. The application of technology, of data analytics, of crunching large amounts of data to find investment opportunities is already here and will continue to move forward. I don't see that going away. And I continue to see increased investment in that as we go forward. I just think we are in a marketplace now where that is part and parcel of what's going to continue to be part of what we do.
So to me, machine learning, using, sort of quantum computing, it's all about speed. And there's always been an arms race in financial markets related to speed and who can be the fastest. And the quicker you can act, the more money you're going to make. And so, there were times when one of our former alums was working as a risk manager for a company that basically was developing computer chips that held their trading code. So instead of actually having to work through an operating system, they were working directly on the motherboard to execute trades. So you would put your algorithm right into your computer and you didn't have to run a program. And so that gave them a real speed advantage. I see this as being largely the same type of an issue. It's just, if you could be faster than your competition, you're going to take advantage of that. So to me, that's the direction that it'll always head. And it's just an evolution, every process.
Yeah, what's interesting about what you just said, Craig, is, I've often debated with people who are against high frequency trading or computing on exchanges, and I think it's an axiom that I think is true. It doesn't really matter what your investment process and decision is. It's always better to be first than last. So even if you are a value investor or someone who's done 6 months of detailed work, when you go to execute your trade, it's always better to be the first to it than the last to it.
That's right. And I've always found this discussion that takes place around HFTs, around co-location and it not being fair, to be kind of misplaced. And for those of you who don't know what that means, it means that if you want to be a high frequency trader, you can invest money and you can receive information about real-time prices before it's actually distributed to the market, because the exchanges, there's something called the SIP, which is Securities Information Processor. It has to consolidate all the price information and then push that out as a real-time feed. In the few microseconds it takes for that to happen, if an HFT can be in front of that, they get to trade on information before everybody else does. Well, I'm telling you right now, that is something of an advantage. But if you took that away and made everybody trade after the SIP release prices, the HFTs would still be the first ones in. So yep, you're not going to have an advantage. So it's sort of, I think there's a lot of rhetoric around it, but I don't think there's much practical importance to it.
Yeah.
So another question, and something that's in highly in vogue, and on every talking head seems like in the morning is talking about it on one of the business networks, are Spax. And the question is really around, are there inherent risks, which is obvious, I think, on investing in Spax? And can you talk a little bit about what a SPAC really is, and then how retail investors or markets evaluate them at this point?
Yeah, I mean, I think there's this has less to do with what I'll call the plumbing of the marketplace and much more of a financial innovation that has positives and negatives to it. So, for those of you who don't know, SPAC is a special purpose acquisition corporation, and it is a blank check. And there are some restrictions on that blank check, but essentially it is a blank check. So by investing in a SPAC, you are essentially buying or investing with a manager or a management team who does not yet own a business. And the theory is they're such a strong team, or they have such good knowledge of an industry or a track record, that you are willing to bet on them and bet on their ability to find an appropriate vehicle in which to buy with the blank check you just gave them. So the risks to that should be obvious to everyone, which is, did I pick the right management team? Are they in the right space? Are they going to be able to find the right company to invest in? There are some protections for investors in SPACs. The protections are that if the management team, after a certain amount of time, cannot find an investment vehicle or a company to buy or invest in, they have to return the money to you as the investor, and oftentimes they have to return it with interest on top of it. So there is some protections to that extent. The other protection is that if you are a shareholder in a SPAC, you actually get to vote on the transaction that's being proposed. Now, for retail investors, you're never going to be of a real size to have that be a meaningful protection for you. You're going to be subject to what the larger institutional holders of the SPAC want to do. So your only protection is betting on a management team and hoping that they pick a good investment for you.
Hey, so Eric, what's the economic distinction between a SPAC and an investment in a venture capital company?
Yeah, so the differences are, one is a SPAC only can buy one thing. So if I'm investing in a SPAC, they can buy one company. And that company will be public and a publicly listed security after the SPAC is done. So it'll be liquid, if you will. You could exit it. When I invest in a venture capital fund, on the other hand, I'm getting a blend of whatever the management team or the management group that runs the venture capital fund wants to invest in. So they may have 10, 15 different investments. And so I'm exposed to all of them. And then my exit, if you will, is usually more difficult. Because when I invest in a VC fund, I tend to be locked up. The typical age is 10 years. Some wrap up earlier. There are some distributions that may happen earlier, but some go longer, where they haven't been able to monetize them. And so I may not be able to exit my investment for some period of time either. So it's the difference between a liquid single-threaded investment in a management team and a longer, less liquid investment in a management team that's spread out over a number of different investments.
Yeah, great, thanks.
Well, gentlemen, thank you very much. Craig, Eric, this has been fascinating. Really appreciate your time this morning and sharing your insights and wisdom with our audience. I want to ask you guys, do you have any closing thoughts you'd like to share with everybody before we shut down today?
Greg, you want to start?
Sure. I don't have too many. I think I hope you gained an appreciation for how complex and sophisticated our current equity markets actually are. But at the end of the day, I'll come back to maybe my experiences at the SEC and understand that there are a lot of investor protections that exist and that make it possible for you to pick a broker and trade with a broker and have complete confidence that not only will your trades be executed, but that the securities that you purchased will be available to you at the time you choose to sell them, right? So there's a lot of, I think you should have a lot of confidence trading in today's markets. And the costs of trading today are infinitesimally smaller than what they were when I first started, when I first bought my first share of stock, where not only was I paying an 8 as a bid-ask spread, but I was paying a significant commission relative to the price of the investment I was making.
I'll echo a lot of what Craig just said, and I will say from my vantage point, I think the market, particularly for retail investors, has never been more efficient, has never been more fair, and allowing retail investors to get exposure to the marketplace. You know, I hate to put it in these terms because I'm sure it'll come back to haunt me, but it's probably the golden age of retail investing. It's efficient, it is cheap, and you get liquidity, and your trades, as Craig said, are completed, and your balances are safe. One of the things I do want to say, though, which I want to make really clear, what modern securities markets do not do and will not do and shouldn't be expected to do is protect you from yourself.
Good point.
So they can't make you go, they can't make stocks go up, and they can't make you be sure that you're making good decisions or making good investments. What they can do is, when you've made an investment decision, it can help you in an inexpensive, efficient, safe way execute that order in the marketplace.
Wise advice there, wise advice. Well, gentlemen, thank you very much. I think we're all beneficiaries of having you guys associated with the school and Vanderbilt and Owen. We really appreciate your time this morning.